Why everything feels more expensive in America. It starts in a place that feels ordinary. A grocery store on a weekday evening. Fluorescent lights, a cart that fills more slowly than it used to. A familiar routine. Milk, eggs, cereal, paper towels, a few frozen meals. Nothing extravagant. Nothing new.
At checkout, the total pauses on the screen for a moment longer than expected.
It isn't shock, it isn't panic.
It's something quieter. A small internal recalculation.
You swipe your card, you leave, and on the drive home, you begin adjusting the rest of the week in your head.
Maybe fewer takeout meals. Maybe delay that subscription renewal. Maybe wait on replacing the tires for another month.
No one announces it. No one makes a scene. But the adjustment happens. And it happens often. Across cities and suburbs, across income levels, across households that would not describe themselves as poor. Everything just feels more expensive. Not in one dramatic way, in small, persistent increments. And over time, that feeling begins to shape behavior. At first glance, the explanation seems simple. Prices rise. That is the visible layer. Groceries cost more, rent renewals come back higher, insurance premiums tick upward. Utility bills fluctuate in ways that are rarely in your favor. But the feeling of expensiveness is not created by any single price tag. It is created by the interaction between prices and expectations, between income and obligations, between stability and uncertainty. And that interaction has changed. For decades, the idea of financial stability in America followed a rough formula. Income arrives consistently, fixed expenses remain predictable, savings accumulate slowly, emergencies are inconvenient but manageable. The formula did not guarantee comfort, but it offered a kind of rhythm. Today, that rhythm feels disrupted. Not because wages have stopped entirely, not because the economy has ceased functioning, but because multiple systems have begun to move at different speeds. Housing moves at one speed, healthcare moves at another, insurance premiums move at another, education costs move at another, and wages often move more slowly. When parts of the system accelerate unevenly, the sensation is not always visible in a single month. It becomes visible over time. Consider housing. Rent increases are rarely dramatic in one leap. They often rise in increments, a few $100s more per month, sometimes justified by market adjustments, sometimes by regional demand. Mortgage rates fluctuate based on broader economic conditions. When rates rise, borrowing becomes more expensive, even if the home price itself has not changed dramatically. Property taxes adjust. Home insurance premiums shift in response to risk calculations. Maintenance costs increase quietly. The result is not one shocking bill. It is a steady tightening. Housing, for most Americans, is the largest monthly expense. When it moves upward, everything else must move around it. Savings shift. Discretionary spending shrinks. Long-term plans get postponed. And because housing is foundational, its pressure rarely feels optional. Now layer healthcare on top. In the United States, health insurance is often tied to employment. Coverage exists, but it is structured around deductibles, networks, copays, and out-of-pocket maximums. Premiums may be deducted before a paycheck arrives. Deductibles must be met before coverage fully activates. Out-of-network charges can appear unexpectedly. A routine procedure might involve multiple bills from different providers. Even for insured households, healthcare costs are not always predictable. The issue is not always the catastrophic event, it is the uncertainty. When uncertainty attaches to an essential service, financial planning becomes cautious, and caution often feels like contraction. Then there are the smaller recurring charges. Subscriptions, streaming platforms, cloud storage, software tools, security services, phone plans, data overages. Each individual amount seems manageable, but subscription-based pricing models are designed to reduce friction at the moment of purchase. $5 here, $12 there, $29.99. The numbers are rarely alarming, until they aggravate. Monthly statements begin to resemble layered obligations rather than optional conveniences. Canceling them requires attention and time, and attention in modern life is limited, so they remain. And the baseline cost of simply participating in daily life rises. Transportation adds another layer. In many regions of the country, a vehicle is not optional, it is required. Car payments extend longer than in previous decades. Loan terms stretch to reduce monthly payments, increasing total interest paid over time. Auto insurance premiums adjust based on risk models that are not always transparent to consumers. Fuel prices fluctuate unpredictably. Repairs arrive without warning. And because mobility is tied to employment access, transportation expenses become difficult to defer.
Again, no single cost is extraordinary, but the accumulation creates pressure.
At this point, a pattern begins to emerge. It is not just that prices are rising. It is that fixed obligations are expanding faster than flexibility. The portion of income that can adopt what might once have been discretionary is shrinking.
And when flexibility shrinks, even stable incomes feel tight.
There is another dimension to this shift: income volatility. While many Americans work full-time, income is not always as stable as it appears. Hours fluctuate. Bonuses are not guaranteed. Contract work replaces long-term employment in certain sectors. Layoffs occur with limited warning. When income is uncertain, expenses feel heavier. A $200 increase in a monthly bill is manageable when income is predictable. It feels different when employment feels fragile. The psychological effect of uncertainty amplifies the weight of each dollar.
Inflation is often discussed in aggregate terms, but lived experience does not operate in aggregate. It operates at the register, in the inbox, in renewal notices.
Official measures track averages across sectors, but households experience specific combinations. A family that rents in a high-demand city, relies on 2 vehicles, and pays for childcare will experience inflation differently than a retiree with a paid-off home. The feeling of expensiveness is unevenly distributed, yet the perception spreads widely, because even households that are not in crisis are aware of narrowing margins.
Margins are rarely discussed directly, but they are central. A margin is the space between income and obligations.
When that space is wide, financial life feels manageable. When that space narrows, vigilance increases. When it disappears, stress becomes routine. Over time, many households have experienced margin compression. Not sudden collapse. Compression. Savings contributions are reduced. Emergency funds remain partially funded. Retirement contributions fluctuate based on cash flow. The future remains important, but the present demands more attention. Debt interacts with this compression in subtle ways. Credit cards offer flexibility and moments of shortfall. Minimum payments maintain liquidity. Buy now, pay later services divide purchases into installments. Auto loans stretch payments over longer periods. These mechanisms provide short-term relief, but they also convert temporary pressure into long-term obligation. Interest compounds. Future income becomes pre-committed. And the feeling of expensiveness intensifies, not because of one purchase, but because past purchases now claim future earnings. There is also the role of expectation. For decades, the narrative of upward mobility was closely tied to rising living standards. Each generation expected incremental improvement. When that expectation meets slower real income growth and faster asset price growth, particularly in housing and education, the gap creates tension. The American dream does not disappear. It recalibrates. Home ownership is delayed. Family formation is postponed. Geographic mobility becomes more difficult. These adjustments are rarely framed as decline. They are framed as adaptation, but adaptation carries emotional weight. Insurance is another layer rarely visible in broad conversations. Health insurance, auto insurance, home insurance, renter's insurance, disability insurance, life insurance. Each serves a purpose, risk management. But premiums rarely decrease. Risk models evolve. Climate-related factors influence property insurance. Healthcare utilization influences medical premiums. Driving data influences auto insurance. The cumulative cost of protection rises. Protection is not optional, so households absorb the increase, and the baseline cost of safety climbs. Retirement planning adds yet another dimension. Employer-sponsored retirement plans shift risk toward individuals. Market volatility affects account balances. Contribution rates compete with present-day expenses. For many Americans, retirement feels both necessary and uncertain. When the future feels uncertain, present expenses feel heavier, not because of their size alone, but because they compete with long-term security. Psychologically, the experience of rising costs manifests quietly. People double-check bank balances more often. They delay purchases slightly longer. They hesitate before committing to travel. They choose subscriptions carefully. They compare grocery prices more attentively. These are not dramatic shifts. They are micro-adjustments. Over time, micro-adjustments shape identity. A household that once felt stable begins to feel cautious. Caution becomes habitual. Habit shapes perception.
and perception reinforces the idea that everything feels more expensive. It is important to recognize that this feeling does not always correlate with absolute hardship. Many households are not in poverty. They are employed, they are housed, they are insured. But they experience fragility. Fragility is different from deprivation. It is the awareness that a disruption, a medical event, a job loss, a major repair would create disproportionate strain. When fragility increases, even ordinary expenses feel amplified.
The modern economy is layered. Asset prices have risen significantly in certain categories, particularly housing and equities. Households that own appreciating assets may feel insulated.
Households that rent or lack investment exposure may not benefit in the same way. This divergence contributes to the broader sensation of expensiveness. Two families with similar incomes can experience financial reality very differently depending on asset ownership. The gap between asset holders and non-asset holders influences perception.
And perception influences confidence. Confidence is rarely discussed in financial metrics, yet it plays a central role.
When households feel confident in their future income trajectory, expenses feel manageable. When confidence erodes due to layoffs, market volatility, rising rates, expenses feel threatening. Confidence is intangible, but its absence is tangible.
Over time, these layers accumulate. Housing pressure, healthcare uncertainty, subscription creep, transportation dependency, insurance expansion, debt compounding, income volatility, margin compression. Individually, each can be rationalized. Collectively, they reshape experience, and that reshaping is often described in simple terms.
Everything feels more expensive.
It may not be a single policy. It may not be a single corporation. It may not be a single market shift. It may be the interaction of multiple systems operating simultaneously, each optimized for efficiency, profitability, or risk management within its own domain.
But households do not experience domains. They experience totals, and totals increasingly feel heavy.
There is no dramatic moment when this shift announces itself. There is no single bill that signals the change. It is gradual, incremental, persistent. A quiet recalibration of what it costs to participate in everyday American life. Groceries, rent, insurance, fuel, healthcare, education, protection, convenience, security. Each category expands slightly, and the space between income and obligation narrows. Perhaps that is why the feeling is so widespread. It is not confined to one demographic. It is not limited to one city. It is not restricted to one income bracket. It is a shared awareness of tightening margins,
A shared vigilance, a shared recalculation at checkout counters and renewal notices.
Everything may not be universally more expensive in absolute terms, but when multiple essential systems move upward at once and income does not accelerate proportionally, the experience converges into a single phrase. Everything feels more expensive. And that feeling, quiet and persistent, shapes decisions long before it shapes headlines.
It shapes when people move, when they delay, when they hesitate, when they commit, when they plan, and when they reconsider. The numbers on receipts tell part of the story, but the narrowing margin tells the rest, and margins, once compressed, are difficult to expand. The pattern is subtle. But once seen, it becomes difficult to unsee. And perhaps that is why the recalculation continues, quietly, repeatedly, long after the receipt has been folded and placed in a pocket. Not dramatic, not explosive, just persistent. And persistent pressure, over time, changes everything. If this perspective felt familiar, you're not alone. You can share your experience in the comments, not for debate, but to add context to the reality many people quietly live through. And if you want more long-form documentaries about the hidden financial systems shaping everyday American life, you can follow The Hidden Cost.